Hi, this is Greg with Advanced Investors. Thanks for watching. Got a lot to talk about. I missed last week's video. Sorry. I'm also a real estate investor, and I got caught up with a closing that went sideways that actually failed. And I've got a new buyer. I had to get the ball rolling. I'm really trying to close this deal, and now it's punted out to the 28th. Anyway, so I apologize. A lot happened last week. It was a shortened trade week. So we had the jobs report on Friday. Oddly, we were closed on Friday for not oddly. It was Good Friday, so happy Good Friday, happy Easter. If you celebrate those holidays. The interesting thing is the U.S. markets were closed on Friday due to the holiday. Europe and Asia were not. But the jobs report also came out on Friday. The employment situation report, also, the non-farm payroll, that kind of thing. So what happened was it actually came out. It looked like a good beat. So what we saw is the Asia markets that traded at night actually did increase, and I'll pull that up. I'm on the Kospi now. You can see the last 2 days. Remember, they traded 2 days literally because Thursday night and Friday. So they did quite well off those jobs data, but we'll get into some things that in the weeds of that report that I think are maybe just now getting digested in the U.S. markets. So you can see it did look like a nice thing for last week, the end of the week in Asia. We did have Europe trade Friday, but not the U.S. Again, the jobs report came out, but Europe was already trading because Kospi is in the middle of the night. Then it overlaps into Europe, which is about lunchtime in the U.S. Europe closes, and that's kind of why I go through the progression that way. So it didn't look terrible. I'm just going to give you a quick hint here. If we flip over to a SPY, this is an intraday. Oops, intraday. You can see from when we closed Thursday, up in this area. I'll just use the line. How about that? Just so we can see it well. To where we are, where we bottomed today, we almost build this, or we almost hit this bottom support. I might actually change that to support line now. But we dropped 0.8%, and now it looks like we're bouncing. This is intraday on a Monday. So this is a weekly video, so I don't want to drill into the weeds of a daily. The other thing I'll look at is I do check the Dow Jones transports. I consider them a canary in the coal mine. You probably hear other people talk about that. To me, if I zoom way out, I don't know. What does this look like to me? It looks like just a lot of chop and consolidation, especially when I start looking at the MACD in your Midland. You're going up and down on MAC, or not MACD, RSI's up there. MACD down here, we're duck billing. That makes me think maybe it's going to flop, but it flattened out. It doesn't know what it's going to do. So I'm not going to say I get much out of this canary in the coal mine. I also like to look at small caps on a weekly basis to see how the small caps are performing as a leading indicator. Maybe not a canary in the coal mine, but they to me look very similar, where it's just kind of flopping around. That being said, this week we have a lot of stuff happening. We'll get into some of the macro stuff as we go too. We have a lot. We have CPI, which is an inflation report, which dictates what the Feds do, right? They like PCE better, but PCI, the jobs report, all that feeds into their dual mandate. Right now, jobs are looking good, except for there's a little bit of wage price spiral still happening. So month over month, wages are going up, but the labor market's been staying steady Eddie. I've been kind of waiting for this big crash in the labor market. It's just not happening. I don't like the month over month wage price spiral because that, like I said, increases our inflation, which is the opposite mandate that the Fed watches. And so they don't want inflation. That's where they watch the PCE and the PCI. They also keep an eye on JOLTS and a few other metrics that involve unemployment and inflation. So maybe we'll have time to look at those a little deeper today. But end of the day is it comes down to really what's going to happen in the future, and as far as rates. So if you look at where we're at today, they're saying there's a 32% chance of a pause and a 68% chance of a hike. Now that was a considerable change over, what is this, 28, 31. These are day by day, so I don't know. But you can see 57 to 70. I don't know, maybe it's not as big as I think, but it feels big. I don't see these move as hard as they move generally, as much as I have lately. And I think that's this imbalance where the market wants to keep going higher, and the Feds are not really trying to fight the market. They're fighting these dual mandates, which affect the market, because when you increase these rates, considering historically where we've been, that's not a good example. If you look at it, a year ago we were in just no interest rates hardly, but we've stacked rate hikes up considerably, to now where we're at the 4.75 to 5% range. And we'll grab a chart of that real quick. I can show you that right now. So if we look at the Fed funds future, which is a tradable futures, the first thing that jumps out at me is this looks like a giant triangle. That means it's going to bust upwards. And where do I find some resistance up there? At 5.02, 5.6, which if you look back at these probabilities, and these look just further out into the future. So if I look at that, what I'm seeing is, okay, their estimates of raising the rates to the 5% mark in May are 70%. That's pretty good. So we're going to jump from the 4.75 to the 5%, very likely. That being said, we've got a lot of data coming in this week that might show inflation isn't going up. If it continues to go down, I think it's pretty baked in the cake. We're getting a quarter, but I find it a little too baked in the cake, because I'm not sure. We'll let the data drive us on that. What I do find interesting about this is that we are literally going to, as early as July, they're pricing in cuts. Now, if you ask the Feds, they are saying no way, probably even all the way to the end of the year. But according to the market, the analyst, this is a series of analysts, they're saying by next fall we're going to be back in this 2.75% range. I just struggle with that, and not because I don't want it, because that would be good for equities, but that would also mean we probably are deep in a recession. So that's why they would cut rates, it would be to help neutralize that. So that being said, let's get back at our charts. Oops, I'm still in drawing mode. Sorry. It's a new tool, so bear with me on that. I'm also trying to be fast because this only lets me do 20 minutes. And that's probably all anybody wants to listen to me for anyway. So with that being said, let's jump back into some of these charts. We look at the VIX. That looks like it's ready to pop higher. Another indication we might see some headwinds in equities. The dollar's running up. Look at today. That's a lot today. So that's looking to be a headwind for equities. I like to look at semiconductors too. They did kind of break out of my, here's a break, retest, fail, retest, breakout on semiconductors, which follow earnings of the banks, which the banks start earnings Thursday and Friday. I think the big names start on Thursday. I do have a graphic I can show of that. I think. Here we go. So on this one, you can see we've got, here, now I'm showing you, this is economic calendar. That's okay. CPI, 8:30 a.m. So that's coming up. FOMC minutes. That's always a market mover. Jobless claims, PPI, and the industrial production output and retail sales. That's a lot of data to absorb this week. So I think when we look at a weekly calendar, this is the SPY weekly. I follow the SPY because it's an ETF proxy of the S&P 500, and I trade it. I'm looking at a lot of overhead resistance. Okay, this week. It just started a few minutes ago. Last week, Doji indecision candle. We had a very strong candle the week before, and now we've run, what do they call those? 3 white soldiers, and then an indecision candle, and now we're dropping. If you look at my SPY daily, I started being concerned. Again, this was last week, 1, 2, 3, 4 trading days. Basically, we started here and ended here. And that's why it's a doji on the weekly. But if you notice, that looks like a topping pattern to me. And so does the RSI, and the MACD's looking hot. Now we might find some stuff here. Maybe we're just going to go down and fill this gap. That'll be something we'll keep an eye on throughout the week. On the monthly, one nice thing I did want to point out on the SPY is we have broken out of this rooftop pattern. We had a very strong month, obviously in April, or in March, April. Well, last week we were a little green here. As of today, it looks like we're going red fast. So I'm going to try not to bore you too much. IEF LQD financial conditions. What do I see here? I see I've got my magnet on, which isn't good to move that. I see financial conditions easing. That said, if you really look at the daily on this, we're pulling back. This is an inverted chart, and I do that just because the blue line is actually the SPX, the S&P 500, and you can see the correlation of how financial conditions affect the S&P 500. So we're at a point of support. We'll see if they continue easing or if we break through and get the tightening. If you want the Fed's take, they want the tightening. On the same inverted chart, I also like to look at the credit spreads. Also a sign of with an overlay of the S&P 500. Also, what we see here is credit spreads easing. Again, they're kind of consolidating over the last week. So this might be a bull flag to go easier or not. That would go against the grain of the Fed. This is the problem. Don't fight the Fed. Don't fight the tape. They say don't fight the tape overrules, don't fight the Fed. I'm in this long only trading position where I'm like, I just want to know when we pivot. But all of this feeds together, and we only touch so much of it in 20 minutes. It's amazing. I do have a chat group, multiple chat groups I'm in, one I moderate. If you are interested in any of that, let me know. Just shoot me a direct message. And we're always looking for good members, but only good members. We have very smart people in the chat group that I monitor, especially. Not to knock the other one, there's just a lot more members in that one. So we don't want to pollute it. And I'm not saying we won't take new people. We take people that want to be. Okay, I'm sounding salesy. I don't even make money on that. I'm looking at other charts I want to show you on a daily. I'm not heavy into following the commodities. We have some great commodity traders in that group, by the way. But one thing I do like to follow is housing. This is another one. Looks like just not sure, which is actually good news for housing, considering all the doom and gloom you hear about it lately. ITP is home construction. Again, kind of range bound, not too bad. What makes that happen? Well, the banks are major players in that, which looked like, this is when we had the banking fiasco, but it's holding on to support here in the banking index. The regional banking index, it looks like it fell through support. I do have a minor gap down here. I think it's trying to go fill. It's arguable I could put another support line right where they're at now, too. So we'll just have to see how that plays out. Some people like to look at the advanced decline lines, advancers, decliners, and it's literally just take the advancers and subtract them from the decliners. So you can see on our last trading day, we actually had just a little more advancers than decliners. All right, let's jump into some of this macro data that's more fun anyway. We talked a lot about this Fed Watch. Here's one for you. I find this one quite interesting. I look once a week, or it pops open every day, but I close it because it only updates once a week on these. But it is the indexes, the profit to earnings. So what it is what's the value of the S&P 500? So this is the one I pay a lot of attention to, right? Historically, profit to earnings is about, I don't know, 15 to 16, probably closer to 16, but let's say 15.5 for this exercise. That's when you'd say it's a fair price for this car, if it were like a car. So we're still extended. Actually, in the last couple of weeks, it's gone up from the upper 17s up to 18, so it's actually increased. And then you look at the forward earnings, and you're like, oh, that's expensive. But then if you look at the trailing 12 months, you go, that was really expensive. Again, I'm a S&P guy. Some people are into the NASDAQ, stuff like that. If you want to pay 26 times forward earnings or 33%, I mean, that's getting kind of scary. Dow Jones, even that looks high. So anyway, I think that's all I wanted to talk about with that specific. We'll even close it. The other thing is, here's our, we already talked about the calendar. I got a couple ways I like to look at the calendar. One of them is just actually in trading view, because, and one of the reasons is if we look at like Wednesday, let's look at core inflation. You can actually open it on a chart. So this will throw, oops, ticks. This is something I do. I have set up ticks are the cumulative amount of buys and sells in the New York Stock Exchange. And when it goes over 1,000, you got a buy program rolling, likely from institutional or some big news event might trigger that. And if you get negative 1,000, that's usually a big sell event. And I'll quick just bring it up. This is how I measure it. I like to line up in a split window with the tick. We call them BICs when you get over the buy line, and we're not even, it's actually scaled off the chart. You can see the sell line alerting, and we call those 6 as a sell tick. So I like to watch where this ranges and the reaction of the SPY throughout the day. But I'm a little off topic. If you look at our monthly unemployment, now this is February's, so they haven't put March's out here yet. So it seems like they're always a month behind in trading view on this. And I mean, I know it's a lagging indicator anyway. The big thing to look at here is if this continues to go down, this core inflation rate, what we're going to see is the Feds are accomplishing what they want, especially if they hold the labor rate steady. And then we can starting to think about that pause I was talking about. I'm not sure I'm ready to say pivot yet, but I'd like to see a pause pretty soon. Maybe that's for my own selfish reasons, but inflation rate year over year, again, you can see this on a calendar. Again, inflation's coming down according to these. Again, that's February 1st readings, so I don't know. I don't have Marches in there yet. I just don't know. That's the downside of this. That's why I have like 3 economic calendars open. There's some points that I like Market Watch better to look at. Like I can look at Market Watch and get a real quick. I trust their estimates better. Oop, you can see my calendar, all the nonsense I got going on there. Anyway, jumping on world markets. This is just today. I should probably refresh this. Again, you can see Europe's closed. Asia actually closed strong. Shanghai, I don't know, take that one with a grain of salt. I'll look at the S&P 500. Wow, just since we started this video, this is gapped down, obviously, and let's just take a peek quick. Yeah, so here's the 5-minute chart of the S&P 500 this Monday. So that's we're going down right up to that minor resistance I have on there. So not much else to talk about on that. Here's a sector chart that I like to look at. I've got it set to the previous for a month back, right? And so let's do year to date just for fun. Year to date, communication is up 22. But this is where people ask, well, what would you buy? And I say, I always like to look. I like to buy weakness. And so if you go, let's look at a year out. What's weak? Real estate. I wouldn't buy that right now just because of the weird stuff going on in the banks and the potential recession in front of us. But this is looking like a good buy into the future. Now, 1 year out, we're still down 20% on consumer discretionary. That's a pretty interesting. If we go to year to date, look at all these all change. Still looks weak on the financials. I'm actually still doing okay on that. I must have bought it early enough. So interesting data. This is also a fun one. I do have this to year to date. Look at the names year to date. These are all mega caps. Those are oddly considered defensive plays now, because where else are you going to put your money? In gold at $2,000, bonds? Well, I have a lot of money in bonds now. Those actually do look attractive, but the volatility of bonds, which is in the MOVE index, is also showing a lot of volatility. Anyway, that's a quick gist of what I got for you this week. Going to be an exciting week, and thank you for watching. Please like and subscribe, and give me a boost on the trading view. And good luck to you this week. Again, happy Easter.